Berlin, 1921. The city is alive, the restaurants are full, the newspapers are running advertisements for summer holidays in the Alps, a professor at Humboldt University is signing a 2-year lease in a new apartment. He has negotiated favorable terms and considers it a sound long-term investment. Prices have risen, people have noticed, but the government has explained it. Temporary disruption from the war reparations. It will stabilize, it always does. 2 years later, that professor's entire savings, every mark he had accumulated across a career, would not buy a single loaf of bread. Not because the collapses aren't predicted, because the human brain, with extraordinary efficiency, had convinced him that it wasn't coming. This video documents the psychological mechanism that has appeared in every major financial collapse in the last 200 years, why people who had access to the warning signs consistently failed to act on them, and what the historical record shows about the people who did. There is a pattern that appears in the documented record of every financial collapse this channel has studied. The warning signs were not hidden, they were visible to anyone willing to read them, and the vast majority of people who saw them chose, with a remarkable consistency, to believe they were temporary. Economists and psychologists have a name for this: normalcy bias, the documented tendency of human beings to underestimate both the likelihood and the scale of a disruption they have never personally experienced before. It is not a failure of intelligence, it is a feature of how the brain processes information. The brain is a pattern recognition machine. It learns from experience, maps what it knows, and when something genuinely new appears, it tends to categorize that new thing as a variant of something familiar rather than as evidence that the entire system is changing. Adam Ferguson, in his forensic study of the Weimar hyperinflation, documented something that should stop you in your tracks. 6 months before the hyperinflation reached its catastrophic peak in late 1923, when a single egg cost 80 billion marks, the majority of Berlin residents surveyed were still planning long-term financial commitments, still taking out loans, still purchasing property, still confident the government would stabilize things. This was not ignorance. The data was public. The money supply figures were published. Prices were visibly rising, but the brain's pattern recognition system had processed each individual price increase as a manageable exception, not as evidence of a fundamental collapse underway. The professor signing his 2-year lease in 1921 was not a fool. He was a human being doing exactly what human beings do, believing that tomorrow will resemble today, because tomorrow has always resembled today, until it doesn't. The historical record does not show that people failed to see the warning signs before financial collapse. It shows that they saw them, and the brain systematically reprocessed those signs as temporary exceptions rather than as evidence that the system itself was failing. Now we arrive at the mechanism that amplifies normalcy bias into something genuinely dangerous. In the weeks before Black Tuesday, October 29, 1929, something was happening on the floor of the New York Stock Exchange that John Kenneth Galbraith documented in precise detail. The technical signals were deteriorating. Trading volumes had become erratic, several major stocks had begun to slip from their peaks. A small number of large investors, including Joseph Kennedy, who we documented in the Depression series, were quietly reducing their positions. And yet the conversations on the trading floor, in the restaurants around Wall Street, and the financial press remained almost entirely optimistic. Business expansion, new highs projected. The modern economy had entered a permanent plateau of prosperity. Social psychologists call this pluralistic ignorance, the condition in which every individual in a group privately holds a concern, but reads the apparent calm of the people around them as evidence that their concern must be wrong. Nobody wanted to be the first to panic. Panic was weakness. Panic was unprofessional. So every person in that trading floor displayed a calm face, and every other person read those calm faces as confirmation that the situation was safe. Galbraith's account of the period is unambiguous. The anxiety was private. The calm was public, and the public calm was the mechanism that kept everyone in place until there was nowhere left to go. In October 1929, the private anxiety was nearly universal. The public calm was nearly universal, and because everyone was reading everyone else's public calm as evidence of genuine safety, the private anxiety never became action, until it became panic. 2 chapters down, 3 left. Chapter 3 is where the historical record gets specific. The documented moments where the warning was visible, the response was absent, and the consequences were catastrophic. Stay with us. The forensic record across 2 centuries of financial collapses returns to the same 3 documented stages: a period of visible warning signs, a period of collective normalization of those signs, and a collapse that arrives with a speed that shocks almost everyone. despite the fact that the warning had been present for months or years. Weimar, Germany, 1921 to 1923. The money supply data was public. The Reichsbank's printing figures were available to any economist who looked. Several international observers, including the economist John Maynard Keynes, writing as early as 1919, had documented explicitly that the reparation structure was mathematically unsustainable. The warning existed in print. The professor in Berlin signing his lease in 1921 could, in principle, have read it. The brain processed it as political theory, not personal threat. New York, September 5, 1929. A statistician and investment advisor named Roger Babson stood up at a business conference and stated publicly that a crash was coming that would be severe. He was specific about the mechanism. He was specific about the likely scale. The financial press spent the following week explaining why he was wrong. The Dow Jones continued climbing for 3 weeks. On October 29th, it fell 23% in a single session. Babson's warning had been public and precise for 54 days. Japan, 1989. The Nikkei index has risen over 500% across the decade. Property prices in central Tokyo had reached levels where the grounds of the Imperial Palace were theoretically worth more than the entire state of California. The Bank for International Settlements had formally warned in its 1989 annual report that Japanese asset prices had diverged from any sustainable fundamental basis. The warning was institutional, documented, and specific. The Nikkei peaked in December 29, 1989. It lost 60% of its value in the following 3 years, and then Japan entered what its own economists call the lost decade, which became 2 lost decades. In each case, the warning was documented before the collapse. In each case, the human brain processed that warning as a temporary exception rather than a systemic signal. The pattern is not a coincidence. It is the most consistently documented feature of every financial crisis in the historical record. 3 cases, 2 centuries. The same psychological pattern every time. What comes next is the mechanism that explains why, and the one signal that Charles Kindleberger documented as appearing without exception before every collapse in history. The next video covers the assets that go to zero in a real collapse, including 2 that almost every financial advisor will tell you are the safest things you can own. Subscribe now so you can see it when it drops. Large financial crises almost never arrive as a single sudden explosion. They arrive as a sequence of small, individually manageable signals, each one rationalizable, each one small enough to absorb, each one feeding the normalcy bias that says the system is still fundamentally intact. Japan's lost decade is the most instructive documented case. When the Nikkei began falling in January 1990, the initial decline was treated as a correction. Healthy, overdue, temporary. When it fell further, the narrative shifted to a medium-term adjustment. When unemployment began rising, each monthly figure was within a range that the brain could categorize as normal cyclical variation. No single monthly data point looked catastrophic. The cumulative picture, a decade of stagnation, a generation of lost wealth accumulation, property prices that never recovered to their 1989 levels, was catastrophic. But by the time the cumulative picture was undeniable, the decisions that could have protected wealth had already closed. Behavioral economists call this the salami slicing of reality. The larger truth cut into segments thin enough that each individual slice feels acceptable, even when the total, it presented all at once, would be impossible to ignore. The documented exit window in every collapse this channel has studied is the same. It exists before the cumulative picture becomes obvious. It closes when the obvious arrives. And by the time most people recognize the total picture, the people who acted in the individual slices have already moved. The historical record does not show that collapses arrive without warning. It shows that the warning arrives in slices, each one small enough to dismiss, each one feeding the belief that the next slice will be the last. The people who survived were not the ones who saw the single dramatic signal. They were the ones who counted the slices. After everything the historical record documents about normalcy bias and collective silence, the question worth asking is precise. Not whether these patterns exist. They are documented across 2 centuries and multiple continents. But what was different about the people who saw them clearly enough to act? Roger Babson is one of the most instructive cases. On September 5, 1929, he publicly warned that a severe crash was coming. He described the likely mechanism. He described the likely scale. The financial press dismissed him. Irving Fisher, one of the most respected economists in America, stated publicly that stocks had reached a permanently high plateau. The collective calm was overwhelming. Babson was not working from secret information. He was working from public data, margin debt levels, price-to-earnings ratios. the gap between asset prices and the underlying productive capacity of the business they represented. He was asking a question that the collective optimism had made socially uncomfortable. What would need to be true for this to fail? Charles Kindleberger spent 40 years documenting financial manias and their collapses. His conclusion, published in Manias, Panics, and Crashes in 1978, carries the weight of that entire forensic record. He observed that every speculative bubble in history, from the Dutch tulip mania of the 1630s to the crises of his own time, was characterized by one recurring phrase, spoken with complete conviction by the people living inside it. This time is different. Without a single exception, every single time that phrase was spoken with confidence, the underlying mechanism was the same as every previous cycle, and every single time, it was wrong. Kindleberger's documented observation is the most reliable signal in the historical record. Not a specific ratio, not a specific price level, not a specific policy failure. The moment when the collective confidence of a market declares that the old rules no longer apply, that, the record shows, is the signal. We return to Berlin, 1921. The restaurant's still full. The newspaper is still running summer holiday advertisements. Imagine now, in the corner of one of those restaurants, a man who's not reading the advertisements. He's reading the Reichsbank's published money supply figures. He's comparing them to the figures from 3 months ago and 6 months before that. He's noting the direction, and he's asking the question that normalcy bias makes so difficult to ask honestly. What would need to be true for this to fail? The people around him think he's being too serious. This is Berlin. Germany has been through difficult periods before and recovered. The government will stabilize things. It always does. He's not special. He does not have access to information they do not have. He simply cannot convince himself that the calm in those faces around him constitutes evidence the situation is safe. 2 years later, when the currency has failed and the professor's lease has become worthless and the savings of an entire generation had been erased, that man is one of the small number of people who had already moved. Not because he predicted the future, because he refused to use the calm of the people around him as a substitute for reading the data. The warning was always there, in the money supply figures, in the margin debt levels, in the price-to-earnings ratios. The question was never whether anyone could see it. The question was whether anyone was willing to disagree with a room. Of the 3 psychological mechanisms in this video, normalcy bias, pluralistic ignorance, the salami slice, which one do you think is most active right now? Leave it in the comments. The answers across this audience are consistently more honest than you might expect. Subscribe. Every video on this channel is built from the forensic record of what actually happened, not what people believed would happen. The systems they trusted stopped working. Next, the assets that go to zero in a real collapse, including 2 that almost every financial advisor will tell you are the safest things you can own. History has the answers. I'll show you where to look.